Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. We want you to not just get retired, but stay retired. You've worked an entire lifetime. You deserve to worry less, which allows you to live more and fulfill these dreams that you've been long pushing off for your entire life. You know, one of the most consistent questions I think I'm receiving this week is how in the world can the stock market be at all-time highs? Let me say that again. How can the stock market be at all-time highs? Well, let's go ahead and break that down and give you some of the sincere and actionable advice that you always deserve and get on this show. So with everything going on, how can the stock market be performing so well? You know, that's a question I've got in a number of forms from different people. And let's remember, the stock market had rocketed higher despite uncertainty over the war, despite the uncertainty over high oil prices, despite the uncertainty of other forms of credit in the marketplace, and of course, the unresolved component of AI, artificial intelligence, uncertainty. Now, admittedly, I would tell someone that this hasn't been the type of environment where you'd normally see the S&P 500, just to call out one index, surging back near all-time highs and trading at multiples that are way above the historic average. Oh, yes, remember, trading at multiples well above the historic average. I mean, hence our theses coming into the year, of course, of what I call higher valuations leading to higher stakes, anything but certain. Okay, because with the S&P, you know, roughly looking at $305 of earnings per share, you know, that puts us at a multiple of roughly 22.5 to 23. You know, it's just a number, but 22.5 to 23 is probably expensive. So if someone says, am I surprised that the market surged back to these levels? No, because there are some legitimate reasons for it. First, the worst case scenario for markets was that oil could surge all the way to $150, $160, maybe $200 a barrel, some crazy number on an extended conflict in the Middle East. Well, guess what, guys? That's all been largely eliminated, right? Oil at these levels right now isn't enough to derail the economy or negatively derail corporate earnings. I mean, it was never about elevated oil prices. This whole thing has been about spiking oil prices. And you know what? That simply doesn't look likely despite all the back and forth that continues to happen. In case you're just joining us, the most common question from clients over the past week is how can the market be at or near all-time highs? So first, I just told you the worst case scenario for markets hasn't happened. What's number two of why the market can be within striking distance of all-time highs? Well, it's this. Earnings, they remain really strong. And the Q1 earnings season is off to a good start, especially from the banks, not just because of their financial results, which were, dare I say, impressive, but more importantly, due to their outlook guidance and commentary. And banks know, as well as any company in the U.S. economy, how the consumers and businesses that they lend to are actually doing. Let me say that again. Banks know how their consumers and businesses that they lend to are actually doing. Now, sentiment, which is how people feel, it's been terrible. But there's a difference between sentiment, what people feel and how they're actually acting. And when you ran through those Q1 earnings from all the banks, there weren't any major red flags that were popping out. So we're talking about how this market can be within all-time highs. We just got done. The worst case scenario didn't happen, too. Earnings per share have been just fine. Well, what about number 3? Well, number 3 is this. Economic growth remains resilient. Fears that the U.S.-Iran war would create a wave of stagflation across the global economy, well, that fear has so far gone, and I think it will go, unfulfilled. Okay? It's unfulfilled. So you have to understand there is a backdrop here where the biggest secret has long been that the economy is stronger than consensus believes. Let me tell you that again. The economy has been stronger than consensus believes. So away from the concept of oil, worst case, not happening. Away from the fact that earnings have been strong. Away from the fact that the U.S. economy remains more resilient, I could argue there's a technical reason, too, why the markets actually climb back to within striking distance of all-time highs. And it's because there was a massive sell-off in tech. Massive sell-off in tech for those who were exclusively long the Magnificent Seven and all the mega cap tech stocks. But what's changed is after that big sell-off, that's where the money came back in recently. And when you've got cap-weighted indices, if those mega cap tech stocks, the Mag 7 stocks, start showing the positive momentum, it's easier for things to get back within striking distance of all-time highs. So listen, to everybody wondering how the market can be doing decent, good in the face of what's been terrible uncertainty so far through the months of March and April, it's maybe this old wives' tale. The market tends to climb a wall of worry. Let me say that again. The market tends to climb a wall of worry. And don't get me wrong, this isn't a perfect environment. This is no longer Goldilocks. Goldilocks was 2024. The environment's not perfect due to valuation, due to momentum. It definitely leaves us more vulnerable to some air pockets. But that's why I want you to have a disciplined, systematic, repeatable investment process that's been TNT tested in the trenches so you too can ensure that your investments are in line with your financial plan. And I want to give you a chance to do that. So reach out and call us today, 833-964-PLAN. That's 833-964-PLAN. Or better yet, navigate out to our website, getretiredstayretired.com. That's getretiredstayretired.com. And when you navigate out to that website, you're going to have all of this great content at getretiredstayretired.com that's going to allow you to download our most recent thought leadership, whether it's radio or TV appearances all throughout the Chicago or the national marketplace. And you're also going to get to download guides like our Investment Outlook 2026. That's our Investment Outlook 2026. And you can take advantage of a complimentary workshop that we'll be holding in the Northwest suburbs, or take advantage of a complimentary consultation. So go out to that website, getretiredstayretired.com. That's getretiredstayretired.com. Download any of our free guides today, like Investment Outlook 2026, and take advantage of a complimentary consultation or attend one of our workshops that we'll be holding in the suburbs of Chicago. Now, what to do when you have a CD that renews, or what to do when you have a fixed annuity that's a multi-year guaranteed annuity that's coming up for renewal. Well, I want people to think hard and long about where those monies should go. And presumably, if you have money in a CD, or you have money in a multi-year guaranteed annuity, that's the type of annuity that you buy for a 1, 3, or a 5-year period of time, you own that because you want to have some safe money strategies. And while there's been talk that inflation would drive interest rates higher, I got to tell you, I just don't think that's the case. Because team, I call you a team, our loyal listeners, remember, the Fed has two mandates. They want to maintain stable prices, but at the same time they're maintaining stable prices, they also want to maximize employment. And in case you haven't been reading the tea leaves, which I don't even think it's tea leaves anymore, you haven't been reading the headlines, maintaining maximum employment is getting tougher and tougher because of artificial intelligence. I mean, we went through and we're still going through a cycle right now where leaders of business are freeing up capital by doing RIFs, reduction in force, to invest in the technology of AI. But we also can see some of the companies who are now benefiting from the artificial intelligence adoption they've already done, which is replacing some jobs. So we've got to come to expect and come to learn that the Fed is probably going to be focused on their second half of the dual mandate. And that's why I think there's a chance to get at least one rate cut still prior to the end of the year, with one or two more possibly coming in 2027. So let's talk about what you should be doing with CD renewal, annuity renewal, and what you should be focused on for the safe money in the bond market. All right, we're going to talk about all of that after a commercial break. All right, in the meantime, you're listening to Craig Bolanos. I call this In the Know Radio with Best Gen Wealth Partners on your favorite station, the station with all the answers, AM 560, The Answer.
You want more In the Know Radio? You want more In the Know Radio? You can't handle more In the Know Radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
All right, I want to talk about the ballast of your portfolio here in this B block. I want to talk about bonds. Bonds are for ballast. What are the different ways that you can search out and seek to hold monies? Now, all of us have been guilty of something. We've embraced, we've enjoyed, and it's been wonderful, those high yield savings accounts, those money market accounts. But take a look, America, they're no longer paying 5. They're no longer paying 4. A lot of them are now 3 point something. And the problem is all it's going to take is a little bit more of a reduction in Fed funds. And next thing you know, we're going to be breaking even with inflation. So in a world that's going to be starving for yield, what are some of the things you can and should be doing in order to be in a position to protect your money? Because remember, it's all about real return. Real return, meaning your return net of inflation and, of course, net of income taxes. So there's a couple considerations. First, if you have certificates of deposit, CDs that are maturing, you may have had a fantastic interest rate. Now you're going into a renewal where the interest rate renewal on the CD is less than what you previously enjoyed. If that is you, then I encourage you to look at some alternatives. One alternative to a simple CD, if you're of the right age and the right stature, maybe consider using a MYGA. What's a MYGA? It's a multi-year guaranteed annuity. That's where you, instead of depositing money at the bank in a CD, you deposit the money with a high quality insurance company and you lock in an interest rate for 1 year, 3 year, 5 year. Sure, there's annuities that go way longer than that. I just don't see a reason, if it's a safe money strategy, to lock in a rate more than 1, 3, or 5 years. And in today's marketplace, you can get rates somewhere between 4.8 and 5.15%. Let's just go ahead and split the difference and call it 5. So one of the first ideas is, if you're looking for a very simple, very straightforward way to get a 5% interest rate each year for the next 3-5 year period of time, consider a simple MYGA or consider an annuity upgrade from your low yielding annuity, low yielding CD to a MYGA, so you too can just sleep at night a little bit more. 833-964-PLAN. That's 833-964-PLAN. Let us help shop for you solutions that make sense. Now, I'm a huge believer that you can build your own bond portfolio with professional help, right? And one of the advantages of building that bond portfolio is, of course, permanence and definition, but it's also liquidity. Because unlike a CD, unlike a simple 3 or 5 year MYGA, those CDs and MYGAs have commitments of time. And they have early redemption penalties if you need the money sooner. But when you build a bond portfolio, you can get liquid. Depends on the pricing, of course, but you can be daily liquid. I think that's great because a big part of getting retired and staying retired is having preparedness and flexibility in your retirement plan. That's preparedness and flexibility. But what do you need to know about building out a portfolio of bonds? Well, first, there's different platforms you can use. You can just buy a bond mutual fund. You could buy a bond index fund. You could buy a bond exchange traded fund, or you can build a portfolio of individual bonds. What's going to be best for you? Well, I think it depends on the balance of your portfolio. It depends on the type, whether you hold money in an IRA or a non-retirement account, and it's going to depend on the sophistication of the advisor that through which you've hired. Now, when I say permanence and definition, I love knowing exactly when my bonds are going to mature. In the same way, I love knowing what the yield to maturity is going to be. Kind of like a CD or a MYGA, you have a maturity date and you have a known interest rate. So if you build a bond portfolio of individual bonds, or you build a bond portfolio of individual bonds and target maturity institutional bond funds, you're going to be able to get diversified, but you're also going to have a maturity date, which means you know when your principal is coming back to you, and you're going to be able to calculate your yield to maturity, which is basically your APR, your interest rate. So why are so many people still allocating all their monies just into the aggregate bond index? Or why are they not using individual bonds? Or why are they not using bond funds with target maturity? And I think it's just scalability. Again, when you work with the team at VestGem Wealth Partners, you're getting a team of advisors with a sophisticated institutional partnership and great access to fixed income desks so that we can curate solutions that are customized to you. And when I say customized to you, you deserve something that's customized to your tax preference. You know, should you be in tax-free munis? Or should you be in taxable bonds? Should you be in tax-free muni bonds that are free of federal tax and state tax? Or should you build a national portfolio? That depends on where you live and your tolerance for risk. In addition to that, in the taxable bond market, I think there's a lot of flavors, but I talk about 17 flavors generally speaking, from treasury to agency, to asset backed, to corporate, to floating, to high yield, you name it. There's a varietal for everybody. And if you want to simply start living off of the interest income of your portfolio, then you need to learn more about doing fixed income, bond investing, safe money investing the right way. And I want to give you a chance to do that. Call us today at 833-964-PLAN. That's 833-964-PLAN. Or go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you're on that website, take advantage of a complimentary consultation or reach out to us and attend one of our upcoming workshops in the suburbs where we'll cover techniques that we use up and down the yield curve, whether we're building barbell, ladder, or bullet strategies to help people be successful in the fixed income world. Yes, all things finance have lots of jargon. Barbell, ladder, bullet strategies. Those are different things that you want to contemplate when you're building a solution that's tailored to you for your cash flow needs and your wealth preservation needs. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Take advantage of that complimentary consultation or connect with us at an upcoming workshop so you too can learn more. Now, away from all those things, I also think it's important that we revisit something. Every time we're talking about getting retired, it ultimately is about cash flow. And cash flow is ultimately driven through the three pillars of retirement income. And let's revisit what those are. Pillar number one is once you've made it, you've got to recognize that you're there. You've achieved critical mass. Don't lose it. And that means having some degree of principal protection is in fact going to matter. And you complement and support that concept of capital matters with pillar number two. And pillar number two is kind of what we've been talking about here. Make sure you're generating sufficient portfolio income that comes in interest, dividend, and distribution payments to cover your cash flow. Because if you're able to live off of the portfolio income and never touch the corpus, never touch the principal, it's kind of like rental real estate, guys. I mean, sometimes the value of your rental property is high. Sometimes the value of your rental property is low. But what do you really care about as a landlord? You care that the cash flow comes in. You care that the rent check comes in. Investing is of a similar variety. When we're investing for yield, you can temporarily sustain ups and downs in price. You just want to make sure you're getting the monthly payments so you can retire off of the earnings only. So as we talk about those three pillars of retirement income, capital matters. That's number one. Number two, generating sufficient portfolio income to cover interest, dividends, payments, so you can just cash flow your way to retirement. You still have to include pillar three, because pillar three is all about outrunning the silent killer. The silent killer is inflation. If you're going to be retired for the next 20, 30 years, your property tax is again going to double. Hell, if you're in Chicago, it may triple. Your cost of living is literally going to double. So you need to have a plan to double, if not triple, your income in retirement. And that means having a portion of your portfolio assigned to growth is going to be mission critical. And if you want to learn how we deploy those three pillars, if you want to learn how we deploy those three pillars of retirement income, you absolutely can, and you should. Connect with us. Connect with me online at GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Or give me a call, 833-964-PLAN, 833-964-PLAN. But we exist to help you not survive retirement, but thrive retirement. Because you want to thrive. You want to worry less. You want to live more. You want to enjoy the life you've always worked for. You're listening to Craig Bolanos, In the Know with VestGen Wealth Partners on AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560, The Answer.
Something I've learned over the last month or two is as we continue to talk about this concept of real return investing, people are like, what do you mean by real return investing? So I'm going to slow it down in the C block today and share with you what I mean. See, real return investing is all about the recognition that over a long time horizon, nominal returns lose their meaning. And real returns are about measuring wealth creation relative to the cost of everything else. Let me say that again. Nominal returns, gross returns, lose their meaning over time Real return measures wealth creation relative to the cost of everything else. Because, guys, you need to be earning money after inflation, after income taxes, and after currency inflation. Well, let me mention that last one again. Currency. See, we've all got US dollars, and I'm proud to have US dollars. I love America, and I know you do too. But there's a trend that's been unfolding for a year now where all these other countries don't want to be as dollar denominated as they once were. Some of that started because of Liberation Day and trade. Others started for other reasons. But guys, this is very real. I mean, this is very real. Look at dollar euro. Look at dollar peso. Look at dollar anything over the last 12 months. That trend is absolutely undeniable. It is undeniable that you need to be diversifying your currency as a component of this concept of real return investing. And there's different ways to get there. But I think when you accept that there's a period of elevated inflationary risk that's secular over time, secular being long term, I think it's just prudent to maximize opportunity to grow wealth. And you've got to start thinking about storages of value. And what are examples of storages of value? Gold, precious metals, they're a storage of value. I would argue digital currency like Bitcoin, storage of value, because we need to address the elements of CPI. And part of addressing those elements of CPI, besides just gold and digital currency, can be real estate and energy. And we have to take our cues from what things like the Treasury Inflation Protection Security Market is giving us. And that's why I think infrastructure is a very big deal. And I think in order to fund these storages of value in things like precious metals, digital currency, real estate, I think money can come from the beta of your portfolio that's in stocks and some of the longer duration fixed income, so you too can embrace some common sense. So that's why these VestGen real return models exist. They're designed to produce a positive real return, and that's a nominal investment return that exceeds the currency inflation experience over the holding period. It's a big deal. And in order to do that, it takes a mix of active allocation at the portfolio level, coupled with the selective use of some active management in the asset classes that are least efficient. And I would love for you to learn more. You can and you should. Give us a call at 833-964-PLAN. That's 833-964-PLAN. And let's talk about how you too can learn about real return investing, because your money deserves to earn a return above and beyond that of inflation, above and beyond that of taxes, and adjusted for currency in a world that is moving towards de-dollarization. Now, don't let de-dollarization scare you. Listeners, team, family, we're still the world's reserve currency. And there's no signs that that's changing anytime soon. When things go bad around the globe, like Russia goes into Ukraine, money flies into U.S. assets. When things go bad around the globe, like Hamas goes into Israel, money goes into U.S. assets. When things go wrong around the globe, U.S. goes into Iran, money flows into U.S. assets. But there's an undeniable trend that other central banks, sovereign wealth funds, and investors around the globe just buy a little bit less of U.S. assets every single month. And that money's going somewhere. It's going into precious metals. It's going into digital currency. It's going into other forms of world currency. It's finding its way into infrastructure and real estate and energy. It's broad-based and diversified. And that's why I am so proud that VestGen provides real return models to our clients to address this very thing. So give us a call, 833-964-PLAN. That's 833-964-PLAN. Go out to our website at getretiredstayretired.com. That's getretiredstayretired.com. And let us showcase with you how we're using our real return models as solutions for portions of your family's retirement income so you too can stay ahead of the curve. Because remember, you got to be prepared. You got to be flexible. Because preparedness and flexibility are the hallmarks of a good financial plan, but you always have to make sure that you're being proactive. And that's exactly what we're doing at VestGen Wealth Partners, is bringing proactive strategies to you and your family so you can do better. 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. Download our information on real return models today. Okay. Why do you need to work with a multifamily office to get retired and stay retired? Well, it's a number of items, but clearly finance continues to get complex, and finance continues to change quicker than it used to, courtesy of technology and the dissemination of information. And I would argue that if you can work with a firm that truly is holistic, you've got your financial plan, your investments that are tied to that plan, you have your cash flow modeling, you have your tax strategy and preparation, you have your retiree health care, and then you've evolved so that your estate planning isn't just documents for agency and executorship and trustees, but you've evolved your estate plan to actually be a reflection of you, because you recognize it's not about giving monies to the ones you love. That's easy. It's about putting the ones you love in a position to be successful. And then you bolt on conversations that are the tough ones, like how to navigate this ever-changing landscape of long-term care. We're going to talk about that next. Well, it's just a lot. It's a big lift, but we've solved for all those things in the multifamily office that is VestGen Wealth Partners. So connect with us today. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. 833-964-PLAN, 833-964-PLAN, and take advantage of a complimentary consultation or participate in one of our workshops that we'll be hosting in the Northwest suburbs. All right. When we come back, I'm going to talk about the avalanche issue in American financial planning. This is information that you don't want to miss, so stay tuned. You're listening to Craig Bolanos, In the Know with VestGen Wealth Partners, on your favorite station, the station that's always had the answers. That's why we affectionately call this AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
So I teased you coming out of that last segment that we were going to talk about the avalanche issue when it comes to American financial planning. And for those of you that have listened to us for years, you know what's coming. For those of you who are new, I talk about this from time to time because it hits home. It's either hit you, or it's hit a family member, it's hit a coworker, it's someone that you love, but it's this concept of long-term care. Sometimes I call it continuity of care, because here's the bad news, guys. Strokes happen, disease happen, falls happen. And the lens through which I look at trying to cure and solve for long-term care in today's marketplace is no longer what it was in the 80s or 90s, which is protecting an inheritance for the kids. No, that is not the lens through which we address the avalanche issue that can really be financial planning in the shadows of dementia. What we do now is we want to protect the healthy spouse. And for everybody, we want to protect choice, because there is a difference between getting care in the home versus custodial care in a skilled facility. There's a difference between choosing between the caregiving agency you want and the one you're assigned. And the barrier to all of these things is cost, cost, and cost. And because we serve clients across the country, insurance is a very state-specific thing, and you are unique. You're as unique as the common denominator of your last name. And the experience that your friends had, the solution of other people, is not the best spoke solution for you. So that's why we always bring in a care advocate, and her name is Jean Osman. And Jean is a national figure who works specifically in this long-term care and elder care space, working to create custom solutions. Jean, you've been on with us before. I appreciate you taking the time out to do a quick segment on a Sunday morning, but explain to us some of the statistics relative to this concept of long-term care, and share with us your story of what gets you up out of bed every single day with passion and vigor to help clients create a solve.
Of course. Thank you, Craig. For me personally, the reason why I got involved in long-term care or extended care was a very personal reason. My grandmother had saved her entire life. Every dime she could get her hands on. She was a depression person and saved and saved and saved to leave a legacy to me and my sister. And she saw that legacy go by and disappear in the course of a year and a half in a nursing home. And I promise you, she died of a broken heart. And after going through that with her and my family, I decided that if I could help one family avoid going through what we went through, it would be time well spent. And I've spent the last 18, 19, 20 years focused on helping families avoid what we went through.
Now, Jean, that is so critical, and your story is touching, and everyone's been touched in this in a different way. Our listeners know about what I've experienced in our family. I shared my mom's story, ALS, Lou Gehrig's disease. All disease is terrible, but that was awful. Jean, what are some of the statistics that everybody's up against when we talk about long-term care in America today?
Well, by the time you hit age 65, if you make it that far, hopefully you do have about a 70% chance of needing some type of long-term care supports and services in your lifetime. But more critically than that, because we're talking about couples and we're talking about healthy spouses, if a couple reaches age 65 together, the statistic really moves up. And at that point, together, you've got a 93% chance that at least one of the two spouses is going to need long-term care supports and services, enough to trigger a long-term care policy.
Yeah, I mean, that's just it. So guys, this stuff is real. And if you want to learn more, you absolutely can, and you absolutely should. Go out to our website at getretiredstayretired.com. That's getretiredstayretired.com. When you're there, I'm going to direct you to our downloadable guides, because I want you to download our guide called A Short Introduction to Long-Term Care. Download for free today, A Short Introduction to Long-Term Care. Or if you want to learn more, you can connect directly with Jean, our authority on long-term care and elder care solutions, 833-964-PLAN. That's 833-964-PLAN. Jean, what are some of the ways that you're creating partial insurance solutions for clients? Because you never want to fully insure the risk. You always talk about partially insuring the risk. Walk us through that process.
Sure. Well, most couples these days have other sources of income as they're getting older, sources of income that they can count on. between pensions, Social Security, investment income, annuity income. They've got sources of income already coming in, so they don't need a long-term care policy to cover the entire risk. What they need is really a long-term care policy that's going to go between where their income leaves off and the cost of care fills up a gap there between income and cost of care. So you need a long-term care policy to fill in that gap between income and cost of care. And so that's what we're putting together for couples today. We're putting them together with policies that no longer have use it or lose it pieces to them, and no longer have premiums that can go up over time. So the policies are completely different than the policies that our moms and dads bought.
And Jean, that's really critical because we've talked on this radio program before, and I want to say it out to the listeners as well. No one in today's market should be looking to purchase long-term care that requires annual premiums when the premiums aren't guaranteed. Because how can you be asked to purchase some form of coverage when you don't know what your future premiums might be? That's called premium risk. So I think what's really critical here is when Jean designs solutions for our clients, we're designing solutions that handle the big three. Number one, I want to eliminate use it or lose it. I want to make sure that if we ever die without ever using the long-term care coverage, that at least the premiums we paid are going to go back into our beneficiaries, aka our estate. Part number two, I only want to buy a policy if we can buy it with a lump sum check, or we can buy it over the course of 3 or 5 years worth of payments. Because what's critical is once that policy is paid with a one-time check, paid over the course of 3 to 5 years, that policy is guaranteed, non-cancelable, guaranteed renewable. It's going to be in full force and effect forever, and we never have to worry about any premium risk. Part number three, I need to make sure that just in case the world gets crazy, I always want to have a reserve shoot. The reserve shoot means that at some point in time, say 20 years from now, we could always cancel the policy, get our cash back in case there wasn't a private solution available in the marketplace anymore. I don't think we're going to have socialized medicine in this country, but there are people who call for things like that, so we need to prep for the change. Now, Jean, beyond that, you're also a big believer that we need to structure solutions that cover all the different areas. I refer to it as home health care, but in assisted to home health care, what other areas are we solving for?
These policies are completely comprehensive. They cover assisted living, nursing home care, home health care, adult daycare. They cover everything. Everything you could possibly need if you need care down the road.
And the other thing that you've been curating is with some unique carriers, they've actually brought policies that aren't just the traditional reimbursement, but policies that can be indemnity. And we're going to talk about what that means after the commercial break, Jean, if you'll give me an additional 4 minutes here on a Sunday morning. All right, in the meantime, I want you to go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. I want you to download our primer, a short introduction to long-term care for free. And then I want you to take advantage of a complimentary consultation and learn from Jean, the authority on long-term care and all forms of continuity of care, so you too can worry less and live more. More to come in the know. Best Gen Wealth Partners.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
So we've been talking about designing solutions to cover that avalanche issue in American financial planning. What is long-term care? And we're lucky enough to have Jean Osman, the big national figure, in the studio helping us out today. Jean, you just got done talking about end-to-end comprehensive coverage. You just got done handling how coverage today can be custom tailored so that it's not use it or lose it. custom tailored so that we can make sure there's no premium hikes in the future, custom tailored with a reserve shoot so we could get our cash back if we wanted to at a future date. But Gene, talk about this other piece of reimbursement versus indemnity, because if people want to preserve choice, and I think protecting choice is really important, why might they want to look at an indemnity policy today?
Absolutely. Indemnity is a great choice, and cash is the other way to look at it. With reimbursement, you're looking at a company sending bills into the company each month. With cash indemnity, the company is simply sending you a check each month for whatever your monthly maximum benefit is. Just simply cutting you a check each month, and you have no restrictions on how that money is spent. So you're receiving a check for whatever your monthly benefit is, and you decide how that money gets spent. You have to qualify for the benefits by losing 2 out of your 6 activities of daily living or having a cognitive impairment that requires supervision. But once you do qualify, they just start sending you the checks, and you spend that money as you see fit. So you can hire whoever you want to be your caregiver. You break down that check however you feel is necessary. No restrictions on how you spend that money.
Absolutely. So listen, if you want to learn more, you can. You want to learn more, you should. Give us a call, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Download for free today a short guide to long-term care. It's a great publication. It's a great primer on this avalanche issue. And we want you to go through the process of really looking at this now. There is some time decay as more and more carriers are starting to do family history underwriting. I think that's a big deal. That makes 2027 an ideal time for you to take a look at making some changes. All right. We bring to you every week sincere and actionable ideas to help you get retired and stay retired. A big part of what we do is future proofing. That's why we talk today about real return investing. Check out those VestGen real return portfolios. We talk to you about how to solve for long-term care. My thanks to Gene, as always, for popping in a Sunday morning, and to you, our listeners. We're here to help you thrive, not just survive.